Welcome back, you legends. I'm Dr. Cal. Let's get right into this quick market update video. I'm going to try and keep this as short and as quick as possible. So let's get right into it. So this is the 1 hour chart 500, and the structure that we've been trading within has been this well-defined range with support at 555 and resistance at 563, just short of the prior all-time high at 565. Recently, before the Nvidia earnings, we had developed this diamond top pattern. A diamond top is where the market begins to trade and then sees expanded volatility, and then the volatility contracts again, then expands again. In this case, the volatility expanded to the downside. We had a break to the downside that held at 555. So 555 remains what I would call minor support. Major support is below at 547. We won't get to 547 until and unless 555 breaks to the downside. That means we need two consecutive closures on the hourly chart, 2 hours below the 555 number, and that will trigger a sell-off down to 547. Now, I know I've recently said a sell-off down to 547 is likely. That's because a breakdown from a diamond pattern generates a target that is equal to the distance between the bottom and the top of the diamond. And if we measure that from the bottom to the top, we get a full measured move down to 547. So that's the full measured objective move if 55 breaks. 5 breaks. If it doesn't, then we simply continue to trade within this range. Realistically, we have a lot of sellers at the highs here. We had a gap up, failed, sold off, had another gap up and rally, failed, sold off, had another gap up, failed and sold off, had another gap up, failed and sold off. This tells me this is now very clear bear sell side territory just above 563. And for that precise reason, why I now firmly believe that the market is more likely to do something that looks like this. Here's the reason why. When you get a well-defined range like this, especially when you start to develop slightly higher highs, where the end of the range becomes more likely that all of these sell side shorts that have stop losses placed at this resistance, they will all likely get taken out. They have to get taken out first before we get that sell-off. You have a lot of sell side liquidity that's been shorting the market at this level. It is now a very obvious level, and it's very rarely the case does the market establish a trading range like this without triggering a fake out, either breakdown or a fake out breakout to smack that liquidity, slap it in the face, right? They have to take out the stop losses. They have to take out the stop losses. The buy side stop losses have not been taken out. In fact, I would argue they are probably raising their stops. That simply means if 555 holds probably for one more day, probably Friday, I would say maximum by Monday. If 555 holds, very likely we rally all the way to new highs, potentially even exceed 565, even exceed the prior new highs, and then form some kind of bearish structure and then break down to 547. And I'll show you why that's the case. We had a very similar looking trading range that looked a lot like this, and we did not get a sell-off really until these, do you see them? These shorts got taken out, and then we had the sell-off. Right? You need to take out these stop losses. You have shorts entering here again, same exact level, and then you took them out, and then you had this bearish engulfing candle, counter rally, failed at the 62 Fibonacci retracement, classic bearish engulfing and failed backtest, and you get the sell-off. Give you another example of a very clear range that we had. Looks a lot like this, right? We had rally, multiple highs, right? Multiple highs, a lot of stop losses placed, major level of resistance, very low, multiple lows, same levels, right? Then we had this slightly higher low, again, slightly higher low. Then once we took out all of these stop losses, we had a big breakout, and that gave us the final top. We did not exceed that, right? We did not exceed that. We had this second bear structure, first, second, third top, bearish engulfing candle looks almost identical to this setup, right? Identical. You have multiple tops, then you get the bearish engulfing, counter rally, 62% Fibonacci retracement, fails, and then you get the sell-off. Actually, let me pull up the Fib retracement so you guys can see what the heck I'm talking about. Here is 62% Fib, trade within it, fail, come back down after a bearish engulfing candle, right? But you first have to take out these stop losses, trigger that final squeeze, give us that final bearish range, and then come down. Now, this all goes out of the window if 555 gets taken out, right? So in comparison, this is our range. 555 is here. A lot of stop losses placed at these highs. So 547, still major support. I think we likely get there, but only after a fake out rally, after these stop losses get taken out, after a fake out move first to get rid of all of these bears, all of this liquidity, take it all out after the fake out move is done. You want to shake out all these weak hands, and then you dump market. Now, to trade this to the upside, that means you have to be very careful. You want to place stop loss at each successive higher low. Even if tomorrow we open lower, right? Something that looks like this, you want to place a stop loss at that low, because that's the only way a trade like this works. Really, if you're looking for these stop losses to get taken on, you want to trade this to the upside, you have to manage your risk of 555 breaking. That means placing a stop loss at 555 and raising your stops each time the market makes a slightly higher low. Now, here's the second reason I think a fake out rally likely comes. And again, it looks a lot like what happened in the S&P 500 as it was putting in this March top. This is the S&P. Let me show you what the NASDAQ 100 looks like on the chart. But not a range. We had this descending channels sell-off. We broke through it briefly and it failed. We had a failed breakout. We did, however, form a slightly higher low. It's really the same theory here. You want to see higher lows, and then you want to see a rally all the way back up to these highs. A rally back up to these highs for the NASDAQ. That means for about 480 of 5 for the triple Qs is going to be equivalent to the S&P 500 exceeding 565. So why does it look like the NASDAQ is about to break out? Well, if I take a look at the 1 hour chart and I take a look at the long-term moving average on the 1 hour, that is the purple line, if you notice, we tend to tag it, pull back ends, and then we rally, tag it, pull back ends, and then we rally, right? This is somewhat of a systematic thing, right? Tag the purple line, rally, tag it, sometimes exceed it. But if we're within this uptrend, that means the uptrend remains intact. And then we continue higher, tag it again, continue, tag it again, continue, break it, but hold the trend line, rally again, continue. We've already tagged the purple line, exceeded it just slightly, held for 67, that key level. And now if the market takes out those shorts that have their stop losses lined up at the top here, if that happens, that means the NASDAQ likely again rallies to 483, 485, something like that. Now here's what the NASDAQ 100 looked like as the S&P 500 was forming this range in the March top. Take a look, S&P 500 basically making equal highs, right? A lot of stop losses placed here on the short seller side. Then you see these slightly higher lows. This is now a volatility contraction pattern or an ascending triangle, whatever you want to call it. Once you get the resistance taken out, the stop losses taken out, you get that breakout. Now take a look at what the NASDAQ looked like. The NASDAQ did not look the same. It had these lower highs, right? The NASDAQ had these lower highs. It was flagging. The NASDAQ was flagging, even though the S&P was trading inside a range, right? Moving sideways. The NASDAQ was flagging. Let's fast forward to today, and you see the NASDAQ flagging and the S&P 500 now trading within that range. I spent all night looking at these charts, back testing, looking at historical data, scenarios playing out, different scenarios and things. And if I want to think about absolute maximum pain, I think this will create maximum pain. The market tends to want to punish the most amount of people, especially when it starts to trade within ranges like this. It tends to want to punish the most amount of people. And I believe the most punishing thing now that folks saw Nvidia break down after earnings, and they're turning more bearish, sentiment bearish. I think the most punishing thing the market can do is break the upside, trap the bulls, take out all of these short sellers, so punish the shorts first, break out to the upside. Then you have the Johnny come lately bulls buy in late and punish those bulls, and then move back down to 547. Now I want to take a look at the S&P 500 daily chart just quickly here. The market did top on August the 26th after it developed this bearish divergence, slightly higher highs on the S&P 500, while the NASDAQ was actually making these slightly lower highs. That was a classic bearish divergence. It called the top and we had a pullback since then. Now the NASDAQ has pulled all the way back to the 16-week moving average. We also pulled back to that key purple moving average on the 1-hour chart. That is again a key supporting moving average for the NASDAQ 100. And after looking at the S&P 500 daily chart, I think the conclusion that anybody has to come to is that if the market actually fails to make any new high from this point onward and it continues to break to the downside Friday and next Monday, I think that is going to be exceptionally bearish outcome, extremely bearish. And that's because the S&P did not match the prior high from July. I think that would be exceptionally, extremely bearish if that happens. And I'm not quite sure we're ready yet for bearishness. Right after the Nvidia breakdown, I think it's a little bit too early. The market does not like to play its hand as plainly as that. Normally, it doesn't happen straight up like that. That's why I think we make a higher high first, punish these shorts first, then punish the longs, then come back down into a mid-September Fed decision. Now, we did look at a lot of ranges, and that tends to happen. That is really what tends to happen. And if you ask me, Dr. Cal, well, how would I know if we break to the upside above these prior highs? If we break to the upside, how can I know we actually dump immediately and then start a significant pullback, right? Or if we do something like this, we instead inch our way higher and then break out and then establish a new range. The simple answer to that is this: if we gap up higher, we open higher above the gap, that likely means we sell off, right? Because all of these longs will want to take profit. It's just, I think, too much of a risk when you open with a gap this high not to take profit. And I think that triggers sell side activity. And we've seen that in a few examples. This is a clear example. We had a big gap up, so we sold immediately, right? And in this example, again, gap up, sold immediately, and a few recent examples, right? Gap up, sold, right? Whenever we see a gap up, we sell. If instead we inch our way higher, right? Inch our way higher, that's kind of boiling the frog kind of setup where shorts get taken out slowly but surely, and then they get absolutely smacked in the face once their stop losses get taken out, and then we get that really nasty short squeeze. I think that is more likely to happen if we see that boiling the frog kind of slightly higher lows forming instead of just a big gap up. And then I think that it is likely that we dump. So to summarize here, I don't want to keep you for too long, guys. Just to summarize here, this is a very late video. If we see successive higher lows, they all hold, and then we inch closer to these prior resistance levels, that means very likely this range breaks to the upside first, trap the bulls, and then come back down to 547. That likely will take a couple of weeks. It's not likely to happen very quickly. That means this kind of slow melt up takes maybe a day or two. Then we get the squeeze, a couple of days, establish a range for about a week, and then get the breakdown. If instead we immediately open higher again, look for a sell-off to establish higher low. If that happens, same deal. If we make a lower low, I think that makes it more likely we continue to trade within this range. 555 as support, 563 as resistance. If 555 breaks, only then do we continue down to 547. Look at the VIX. The VIX is trading sideways. Not a lot of information from VIX. Not a lot going on with the VIX. Let me take a look at the S&P 500 futures just very quickly here. Still trapped within the range. Fake breakdown to the downside in the futures chart, not on the daily chart for the S&P or the hourly chart for the S&P, only in the futures, so outside of market hours. That happened after the Nvidia breakdown. We're now trading smack in the middle of the range. So again, you want to see higher lows establish themselves. That means over Friday, potentially Friday and Monday, and then we get the breakout to clear these stop loss orders from bears and shorts. NASDAQ 100 still in this bull flag, very similar to what happened during the March top. If you can see, we had this kind of flag. Then we moved sideways, cupped that cupping formation. Then we got the squeeze and the breakout. On the S&P 500 futures, that didn't happen. We had a range with a slightly higher lows. See that? Higher lows. And then we flagged near the resistance, and that gave us this. So again, that will be what I'm looking for. Look for slightly higher lows, and then kind of look for consolidation near these highs. We don't want to see impulsive sell-offs like these. We don't want to see that for a break to upside. Again, alternatively, we break the bottom of the range, we sell off at the moment, at this particular moment. I think it is more likely, in my opinion, based on what I've seen the market do time and time again, it's more likely we break the upside first, trap the bulls, and then come back to the downside. I think we need to make a new. I think that needs to happen, and I think the Nasdaq needs to make a lower high. I think the Nasdaq needs to fail to make a new high. Just fill this gap, fail to make a new high. That'll establish a significant bearish divergence, and I think that sets us up more sell-offs to come in the rest of September and the rest of October. Let's just do economic events very quickly. Friday, core PCE and headline PCE before the market opened. CPI came in better than expected. That means PCE will come in better than expected. That means if we gap slightly higher, look for a small dump after the market opens as the Michigan Consumer Sentiment report comes in. So you want to see something that looks like this, right? Open slightly higher, potentially to these prior highs, right? So let's see around 561, something like that. Open slightly higher, then get a quick dump, but make a higher low, right? Quick dump, higher low after the consumer sentiment comes in. That happens, we make that higher low. I think very likely we break side. If instead we gap up on PCE and then we break this low and then sell off and continue to sell off on consumer sentiment, I think that means likely 555 breaks. To put it very simply, this prior low needs to hold at 5.7 to really for that a boiling frog sort of setup to succeed, for a bullish triangle setup that breaks upside. That's all I have for you today, legends. Thanks so much for watching. Catch you in the
Oh, wow.